No, because if we do eventually see mean reversion in the market, I'll say this, if the markets go down 50, 60, 70% as they should at some point, unless we nationalize them, literally, we could do that. But in a moment of mean reversion or even a recession, anything that's not nailed down is going to be necessary to cover margins. And so gold could retrace. We can't be certain of that, but even as a gold executive, I can't just say gold only goes up and to the right. So of course, but the trajectory, secular, 3,000, 3,500, 4,000 is just the beginning. And that shouldn't be to get your juices flowing for speculation. You should buy gold for 20, 30 years out for the long term, because there's no miracle for paper money anymore.
MatthewPiepenburg, a respected financial expert known for analyzing global market trends, debt, and precious metals, consistently advocates for viewing gold as a long-term safeguard rather than a vehicle for short-term speculation. Recent market activity has brought renewed attention to gold, which reached approximately $2,900 per ounce on Monday after experiencing its most significant one-day drop in 2 months. Despite this volatility, traders remain focused on potential market disruption stemming from U.S. President Donald Trump's tariff threats. This short-term fluctuation exists within a broader secular trend that suggests that gold could appreciate between $3,000 and $4,000 per ounce in the coming years. Contributing to this bullish outlook is the continued accumulation of gold by central banks of countries seeking protection from U.S. sanctions. This trend accelerated following the freezing of Russia's international reserves after it invaded Ukraine in early 2022. Analysts project gold prices could reach $3,000 in the near term and potentially $4,000 by 2026. Driven by this strategic diversification away from dollar-denominated assets. While gold typically delivers more substantial returns in short and medium timeframes, making it an attractive tactical investment, Piepenburg emphasizes its value as a 20 to 30-year investment strategy. This longer horizon provides significant benefits, including reduced exposure to negative returns and enhanced probability of achieving 7% to 10% returns. His perspective is grounded in the persistent concerns surrounding paper currency, for which he sees no immediate solutions. Piepenburg's advice represents a balanced approach. Acknowledge gold's potential for substantial price appreciation while maintaining discipline by viewing it primarily as insurance against long-term monetary uncertainty rather than as a speculative asset. Before we begin, subscribe to our channel and click the bell icon to stay updated with our latest content, market insights, and expert analysis.
Gold only goes in a straight line. But what we are seeing now, undeniably, in the last couple years and really gaining momentum in the last year and a half and certainly the last few weeks, is that, again, the gold market is going to go into a secular bull market, not because gold's properties have changed or gold has gotten shinier or more interesting or more aware. And frankly, the West still doesn't understand gold. The gold market is rising because the fiat money world, the U.S. credit system, the global credit system, which is money to them, which is just credit, is in a clear bear market. And the most simple way to say that and show that is you have to remember, it's a fiat bear market. A 400-ounce bar of gold, when we had 1971, before we went up the gold standard, I think it was 17,000. A 400-ounce bar of gold today is 1.14 million. Again, gold has not gotten stronger since 1971. The U.S. dollar has gotten weaker. That's why the gold price is rising. The dollar is getting weaker because it's been monetized to an extreme and criminal degree to cover U.S. debt levels, which are beyond the pale of rational, the highest debt levels in the history of the world and certainly in the history of America. If debt destroys currencies and debt destroys empires, we are at that turning point. Again, not the end of the world, but a very different world. Not the end of the world reserve currency, but a very different currency, respect-wise, use-wise, tier-wise, strategically reserved-wise. The de-dollarization of the BRICS is not a joke. The de-dollarization of the Comex is not a joke. The move towards gold is not a gold bug argument. It's history in motion. And the price of a gold bar, a 400-ounce bar from 17,000 to over $1 million, is not a gold bug argument. It is a symptom of fiat money in general and the U.S. dollar in particular dying. So people need to get past people talking their book or gold guys talking up gold. But of course, gold is going to go higher because there is no way out of this debt crisis. There are three options with gold. Or the U.S. debt crisis. We can default, which I don't think is a real option because we have a money printer. We can add a zero at any central bank and solve the default problem. We can try to produce our way out of this debt crisis through GDP, but as von Mises or David Hume or Ernest Hemingway or any good professor in any business school will tell you, when your debt to GDP crosses 100% and gets into the 125%, mathematically your growth stalls by 1/3. So we can't grow our way out. So the only other option, the third option, is to inflate our way out. We're debasing the currency. As we debase the currency, gold goes up. As gold goes up, nations and counterparties on the Comex want their gold out of the warehouses, and nations around the world want to buy twice as much gold as they did pre-2022. They're buying twice as much now because they trust gold more. It's that simple. Does that mean that gold will only go in a straight line? No, because if we do eventually see mean reversion in the market, I'll say this, if the markets go down 50, 60, 70% as they should at some point, unless we nationalize them, literally, we could do that. But in a moment of mean reversion or even a recession, anything that's not nailed down is going to be necessary to cover margins. And so gold could retrace. We can't be certain of that, but even as a gold executive, I can't just say gold only goes up and to the right. So of course, but the trajectory, secular, 3,000, 3,500, 4,000 is just the beginning. And that shouldn't be to get your juices flowing for speculation. You should buy gold for 20, 30 years out for the long term, because there's no miracle for paper money anymore. We're seeing extreme examples of that right now at the Treasury auctions, at the Comex, among the BRICS nations, all of which have their own problems, by the way. It's not as if the BRICS are totally healthy and America's the only one ill. It's not as if the things that Trump is trying to do to cut spending are totally naive. What I'm saying is it's far too little, far too late. And so to your question, yes, gold will continue to go higher, not in a straight line. Of course, if we have a real crisis in the markets and the markets are got plenty of needles pointed at their red balloon, you could see a small retracement in gold and then really raking high to all-time highs. If you're a speculator in gold and you're waiting for that price pullback, fine. If you're an owner and you're looking 30 years out, whether you buy tomorrow or wait for a pullback is irrelevant.
MatthewPiepenburg has recently observed a significant shift in the gold market, with increasing demand for physical gold at the Comex in the past few months. This trend reflects growing concerns about paper assets and a renewed appreciation for tangible stores of value. According to the monthly bulletin for gold broker clients, January witnessed a substantial rise in Comex gold stocks. Over the past 2 months, approximately 500 tons of gold, equivalent to about 40,000 good delivery bars, have been quietly accumulated across 9 Comex vaults, including major facilities operated by J.P. Morgan, Brinks, and HSBC. This substantial increase in physical holdings represents a notable change in market behavior. Piepenburg identifies diminishing trust in U.S. Treasuries and the dollar as key drivers behind this phenomenon. Countries and trading desks increasingly seek tangible gold rather than paper contracts, suggesting a fundamental shift in risk perception among significant market participants. The current trend aligns with gold's historical reputation as one of the world's oldest and most trusted forms of currency. Investors are drawn to gold's intrinsic value and haven qualities, making it an attractive option for portfolio diversification. These attributes have long made gold popular among intraday and swing traders seeking stability amidst market uncertainty. Let's get back to the video.
What we've seen in the last few months, which is no surprise, is the Comex is thirsty for more physical gold for a number of reasons. The headlines say that the Comex is worried about tariffs under the new administration on gold imports, so we got to get gold in now before those tariffs kick in. The other very eloquent and reasonable argument is there's a price arbitrage between the spot catch price in London and the futures market in New York, and so you got to move this physical gold to do an arbitrage play. Again, to the average person reading the New York Times or the Wall Street Journal who doesn't track Comex or futures markets, that sounds perfectly reasonable. The obvious reason to any of us who understand, whether it's Peter Umbro who brought this out or the WikiLeaks years ago, since 1974, the reason the Comex was created was to legally price fix the gold price. And the way to do that is to have a certain amount of physical gold on tap so that you could meet Basel III regulations and commit to this legalized futures contract price fixing. What's happened now is the Comex has run out of physical gold. And why? Because typically on the Comex for years and years and years over a generation, these futures contracts are just rolled over in a perpetual game of we'll pretend to order, you'll pretend to buy, we'll pretend to take delivery. But really what happens is we just extend the contracts. All the futures contracts for very cheap are just renewed for almost no cost because that just keeps the liquidity, quote unquote, the trade moving. But what's happened now is you're seeing a 750% increase in open interest on the futures market. That's fancy lad talk for counterparties on the Comex actually want their physical gold. Okay, they want their physical gold out of the warehouses, and the Comex in New York simply didn't have enough. And so what does that mean? Well, it means a number of things. First of all, it means, as Andy Schectman and many of us have been talking about for years, this game can only go on as long as the Comex has the physical gold. But the reason they don't have the physical gold, for all the reasons the BRICS are de-dollarizing and from the reason Charles de Gaulle came in New York Harbor in 1971 and the Germans in 2016 and India and China since, why everyone's repatriating their physical gold. They want their physical gold because they think of it as a better tier one strategic reserve asset than a U.S. Treasury or an IOU from Uncle Sam, who has a weaponized and over-indebted dollar and untrusted IOU or U.S. Treasury. It's that simple. And so countries, counterparties, trading desks, you name it, want actual physical gold, which is completely new to the churn and burn, keep it spinning and rolled over Comex market of old. And so what we're seeing here is a fascinating symptom of what is not being discussed openly. This is not tariffs. This is not price arbitrage between New York and London. This is a world turning away from the U.S. Treasury as a tier one asset, turning away from the U.S. dollar as a safe asset, and preferring that boring analog pet rock physical gold as a strategic asset, as the BIS has warned, as the BRICS have shown, as frankly even the Trump administration and Scott Bessent recognize. Scott Bessent's a very big gold investor. But you can't say the quiet part out loud. You can't have the New York Times, the Wall Street Journal. I'm not a conspiracy quack, but you can't say the world wants its gold. Comex is being drained because no one trusts Uncle Sam's IOU. Physical delivery is going out the door for a reason. You can't say that because what that means is the gold price is rising, as we're seeing, all-time highs in all currencies at the same time this is going on. This is not a coincidence. If the gold price rises, this is a thing that terrified Kissinger and Nixon and Volcker years ago. If the gold price rises out of control of the Comex and the permanent boot to the neck under the futures market, that means the U.S. dollar, the mighty dollar, and the U.S. 10-year Treasury, the IOU, simply isn't what it used to be. Doesn't mean the end of the dollar, doesn't mean the end of the world reserve currency, doesn't mean the end of the 10-year IOU. It just means that we're no longer talking about when things are breaking down. They are breaking down.
The rising demand for physical gold and its increasing storage in Comex vaults signifies a significant shift in the market. As gold plays a crucial role in global financial systems, its value remains solidified as a strategic asset. With growing concerns about the stability of fiat currencies and trust in traditional financial instruments, gold stands as a secure alternative. What are your thoughts on gold's rising importance in today's market? Let us know in the comments below. If you found this information valuable, like, subscribe, and hit the bell icon for more updates. Thanks for watching.